Welcome to this Risk Readiness webinar. I'm Ann Adams, a Senior Product Manager for Business Solutions at Risk Management Association. We're proud to make this presentation complimentary to our members. If you're not a member, please explore all RMA has to offer at rmahq.org. And this is the latest installment in Credit Trends and Commercial Lending by Credit Risk Navigator, and it's going to be presented by Tom Cronin at AFS. So for that, Tom, I will hand it over to you.
Thanks, Ann, and hello to everybody attending today. We have the third quarter results today, and you're going to see a number of charts comparing September 2023 versus December 2022. So it's a look at where we were versus where we are, and you're going to see a number of significant changes today. Today is also the second installment of our detailed look at the Credit Risk Navigator dashboard, which is the source of our data. But before we get going with that, I wanted to let everybody know that this is the 20th anniversary of the Credit Risk Navigator. We've been providing commercial loan performance, credit quality, loan growth benchmarking for banks and their peer groups since the third quarter of 2003. So we're very pleased, and to the best of our knowledge, this is the oldest commercial loan bank benchmarking service that's available to anyone in the marketplace. All right, I'm going to switch over to the dashboard quickly. So last time we met in August, we had showed you quick idea, the executive summary, so the first dashboard, and it gave you a quick idea of what's happening with your portfolio. This next web page, the early warning web page, has much more detail. You can see right up at the top, it has 5 tiles. It's bookended by the performance tiles, the past due on the left, non-accrual on the right, line of credit utilization in the middle, along with classified and criticized loans. And for those of you that are not familiar with the RMA 10-point scale, criticize our loans 7, 8, 9, and 10, so special mention, substandard, doubtful, and loss. Classified just removes a special mention. For each one of those tiles, you see a speedometer with historical performance of each one of these measures. So the green would be the best, the yellow is the middle, and then the red is the worst, and that's based on the market average. There are 4 charts on this web page. The first one here on the upper left is the bank data only. So if you had joined, this would be your bank data for non-accrual loans. And then the other 3 charts have your data, the peers, and the market data as well. So the non-accruing trend, the worst performing industries, and the worst performing geographies. Those have your data as well as everybody else's. And I thought maybe the best way to show you how banks are using this web page is to walk you through an exercise we've recently conducted. One of our clients, who is based in Indiana, was looking to expand into a neighboring state. And they were trying to see what was the overall performance of loans in Michigan versus Kentucky. So what they wanted to do was look in non-accruals, and we had the filters. So we opened the filters for them, went into geography, came down to USA, and then Eastern Midwest. And we first looked at Kentucky. So you just click on Kentucky and you can see how easy this is. Hit apply. You'll notice a second it'll change. So if I clear that out, so this 2.7 non-accruing is the bank's loans, but they didn't have much in there, so they would really want to look at the market. So to see the market, we go to this table, and if you drop down, you can see here for 2023, the non-accruals for Kentucky for the market are 0.49%. So they saw that and said, okay, let's go see what we have or what might be there for Michigan, because that was the other option that they were looking at. So you just click on Michigan. Again, come back up and apply, and you'll notice it'll change. And then we come back to what I call the waffle. And if you look at the market now, 2003 market for Michigan is 109. So almost double what you saw in Kentucky. So this is a way that a bank would use CRN to kind of get a feel. Obviously, there's more things involved in terms of, what are the opportunities to have talent, hire talent. But this was just an initial foray into looking at these two areas, gave them an idea that the performance of the Kentucky market was a little bit better right now than what they were seeing in Michigan. Okay, so now let me go back to this. We'll start with C&I data as usual. A quick definition. So we define C&I as business purpose loans to borrowers with annual sales north of $1 million. These loans are manually underwritten and risk rated. So this portfolio does not include what you would call exception managed or delinquency managed loans or mass risk rating. There has to be some manual underwriting and risk rating here. And loans secured by owner-occupied real estate are tagged as C&I. And I want to preface my comments with this table. And I'm not trying to be preachy or try to be an economic professor or anything, but I think everybody knows this, but I just want to show some numbers here about the impact of increases in price and rate. So this is a table that has the average home price, the average mortgage rate, and the monthly payment, just with that price and rate. And you can see I start at 4Q19 with 384,000, a rate of say 3 3/4, gives you a monthly payment of $1,700. Fast forward almost 4 years, and you have not only the higher rate, which a lot of people have, that seems to be the topic, but you have the higher home price as well of almost $500,000. So this results in a monthly payment of almost $3,200, which is about a difference of almost a little over $1,400. And even though this is home price, it really doesn't have to be homes here. You could substitute wool for borrowers that make sweaters, or copper for those that manufacture electronics. The outcome is going to be the same. You have a higher cost of goods sold and higher borrowing expenses. They're not being offset by increase in sales. And we're going to come back to this theme several times today, because this is what's happening in the economy right now. And you're beginning, as you'll see in a second, we're beginning to see some cracks. And I think it's the combination of the inflation and the high interest rates. So here's our non-performing and delinquency trend chart, or our performing trend chart. And last month we had a big jump in short-term past dues. It was up above the 0.5%. And we've cautioned, as we have in the past, that short-term delinquencies really fluctuate, and to look at something over a 1 month period and make some sort of decision is folly. And I did that last month, and then I'm kicking myself this month. Initially I was, because you can see the good news is the gold line there, the short-term past dues are back down. The bad news is that we're seeing elevated levels of medium-term past dues, the green line, and also non-performing loans, which is the blue line. And when I say non-performing, I mean non-accruals and accruing loans that are 90 days past due or more. So these are loans that are really in trouble. Now, the non-accruals haven't been at this level in about 1.5 years. And May 2020 is the last time we saw 60 to 89 days past due this high. And we'll look at the detail in a minute, but it appears, as I just mentioned, that we're starting to see the impact of inflation and higher for longer interest rates, as several companies are seeing an increase in their expenses, not only borrowing costs, but also cost of goods sold, and is starting to impact cash flow. So here we have the first of many December 22 versus September 23 charts. And this chart enables us to compare the non-performing levels of each 2-digit NAICS code now versus at the beginning of the year. And this will help us zero in on what's causing the change we saw on the previous slide. Now, overall, there are 15 increases or deteriorations in credit quality and performance, and only 9 decreases or improvements. And on the negative side, the most notable changes, very easy to see, smack dab in the middle, are 45 retail and 55 information. We're also seeing significant spikes for 32 manufacturing, 48 transportation, and 61 educational services. But let's take a closer look here at 45. So since it had the largest change and is now the worst performing industry sector, so 45 is retail, I thought we'd take a deeper look into the subsectors that are having trouble. So I combined on the left 451 and 459. They're very similar, had same names. And you can see that they're bad. Their non-performing loans are above 6%. Now 454 non-store retailers is the worst at above 10, but that's actually a very small dollar amount. So the real problem here is with the sporting goods, hobby stores, and bookstores. And I think this has been going on for some time. The sporting goods stores had a shot in the arm when COVID hit, but since that time, they're down, as are the bookstores, and just discretionary consumer spending in general is off. So non-performing by geography, and for C&I loans, when we say geography, we're looking at the location of the borrower, not the bank. So a loan to FedEx would come out here as being in Tennessee. And let's say, for argument purposes, that the Eastern Midwest, the Northeast, and the West are flat. And that leaves us with all the other regions worsening when you look at December versus September. The Western Midwest is having the most issues, and their issues are with some of the things that we've just talked about. 45 sporting goods, 48 chartered air, which is transportation, and then 42 grain wholesale. And similar to what we saw with the industry sectors, the drop in performance when measured by non-performing is pretty widespread. The decline is happening for many sectors and primarily throughout the United States, with the few exceptions, the Eastern Midwest and the Northeast. All right, so now we're going to switch to credit quality. But as we do that, Anne, I'd like to launch the first poll.
Sure, here you go.
So this is sort of a tactical question, if you would, or a operational policy question. So, pardon me, when you rate borrowers, other than financial statements, do you factor in any of the following items? And that could be condition of the industry, location of the borrower, size of the facility, past borrowing experience, or collateral. So, and you can, if more than one, feel free to select more than one. We're just trying to get an idea for what's important when you're doing your risk ratings. And again, I'm assuming that financial statements, everybody looks at financial statements. That's why that's not an option here. Okay.
Okay, I'm gonna get a couple more come in late, but I'm gonna end the poll now.
Right. Okay, so 83 on the industry, 57 location size, they're very low, past 77, 92. Okay, so it looks like all of these, with the exception of size of the facility and a little bit on location, have. So I'd be honest, a lot of these polls I have I think I have an idea what the answer is going to be. This one I had no idea. So this is interesting that we have this. So, okay, let's move on and look at credit quality. So at the end of all these webcasts, if you've joined us before, you know there's a survey. And the survey asks not only how we're doing, but what sort of things do you like to see and what do you want to see? And one of the things that comes up at the end is that you always ask for more information on credit quality. So we have a number of new charts for you today looking at credit quality. Here's the trend in weighted average risk ratings. And just a quick reminder, again, if you're new, when a bank joins the Credit Risk Navigator, we map their borrower risk ratings into the RMA 10-point scale. And that scale has 1 through 6 as pass loans, with 1 being the best, 6 being low pass. 7 is special mention, 8 is substandard, 9 is doubtful, and 10 of loss. So that gives you an idea of where things work out. And so here's the history, the weighted average risk rating history since 2003. And when I first looked at this, it reminded me of a camel. I guess you call it a Bactrian camel with 2 humps. So there's 1 hump there for the recession in 09-10, and then another hump there for the COVID impact. But now it looks like we're starting another hump. So I don't know what a tri-humped camel is called, or if there even is something. The latest increase started at the beginning of this year as banks began to prepare for the likelihood of decline in performance due to high inflation and high rates. And thinking back to our first chart, this earlier increase in weighted average risk rating has correctly predicted the performance decline that we're seeing today. So here we've combined the RMA 10-point scale into 4 main categories. High pass, 1, 2, and 3s, moderate pass, 4s and 5s, low pass is just 6, and then traditional criticized 7, 8, 9, and 10. And the blue column is for December 2022, the gold column for September 2023. And you can definitely see a shift, an overall shift to the right or less favorable ratings. We're going to look a little deeper here into some of these, the 6s and aboves, but you can see that the credit quality just in this year alone, in the first 9 months, has definitely shifted to the wrong side. So here's what I call the 6 and above. Explain a little bit what I'm doing here. Historically, regulators had called anything 7 or above as being criticized. And to the criticized here, I'm adding the 6s. And I'm tagging this entire group as being distressed loans. And I've done this because of the CCAR work we did just prior to COVID. We found that up to 30% of the 6s migrate to criticized within a 2-year period. And so it just seems more appropriate to examine the expanded section of the portfolio, with everything 6 and above being distressed, especially as there's some economic uncertainty. And you can easily see the increase in the distress level, not only for the 6s, but also the 7s and the 8s. There's that bump up in the 8s is almost doubled. That gives me a little bit of concern, because the special mention, as we mentioned, kind of comes and goes. The substandard, you're starting to see some really some issues with loans there. So that increase has me a little concerned. Now here we're looking at the stress volume trend by industry. And let's drill down once again into the 2-digit NAICS code and see where each was in December 22 versus September 23. And when you get a chance, compare this change to the non-performing chart and look at the differences. And if you'll notice in the upper right, I have the number of increases and decreases. If you remember the non-performing, it was 15 and 9. Here, the stress ratings have increased for every industry with the exception of 2, 23 construction, and then 92 public admin. And public admin is basically always okay, so that probably doesn't even count. And 23 construction is down just a little bit. The ratings have jumped the most for 49 transportation, and within transportation, it's warehouses. We're going to come back to that a little bit later when we talk about CRE. It's also gone up for 31 manufacturing, which is now the highest level. Almost 40% of the loans are 6 or above. And within 31 manufacturing, it's for food manufacturing, beverage, and apparel. 71 arts and entertainment is up. And within there, that's for dinner theaters, spectator sports, and promoters. And then 51 motion information. The problem with there is motion pictures and telecom. And you'll notice for 31, 71, and 51, everything I talked about there could fall under the consumer discretionary category, which we have talked about for over a year now, as those are the type of industries that get impacted first and heaviest by inflation. As consumers choose what to purchase, one of the things they'll stop doing is going to movies, things like that. And that's what we're starting to see. So here's distressed by geography, and credit quality is down throughout the country. Almost every region except the Western Midwest is above 20%. And within the Eastern Midwest, which is now tied for the highest level of distress, we're seeing issues for 62 nursing and retirement homes and 33 manufacturing. And within that, it's fabricated metals, machinery, and motor vehicle parts, all having above average levels. Within the South, which is tied for the highest level, they're above average levels for 52 credit intermediation and 62 healthcare, again, nursing and health offices. And in both regions and in most of the other, the increase in distress levels is widespread. So the performance numbers are going up a little bit, and the outlook, if you would, or the credit quality numbers are also showing some problems. So we want to wrap up C&I with this chart that this is one of our new charts where we put performance and credit quality together. Since this is new, give me a second to explain it. The 2-digit NAICS is on the far left. Non-performing is the first set of bars, so in the middle in the red. And then the weighted average risk rating is the second set of bars on the far right, or the orange or gold. And this chart speaks to the correlation between performance and risk ratings. And in the past, we've not seen basically a 1-for-1 correlation. There's frequently we'll see an industry that's not performing well, but it has a risk rating that's average. But now we're seeing some differences. If you look at the extremes, performance and credit quality are lining up exactly. So 45 retail, you see that has the worst performance at 3.16. It also has the worst weighted average risk rating at 536. Conversely, public admin down at the bottom basically has nothing, 0.09%, the best performance, and also the best weighted average risk rating at 2.25. Now, in between, there are some outliers. There are some poor performers that have decent credit quality. 32 manufacturing is an example of that. One of the highest non-performers, but one of the better risk ratings. And then there's some good performers that have bad credit quality. 49 transportation is an example. But overall, these two measures tend to be in line. And I think if you can take this, it gives you an idea of who's not performing well, and who, if the weighted average risk ratings and outlook, who have outlooks that are not very favorable either. All right. So now we're going to move on to commercial real estate. And here's our definition of CRE. We follow the interagency guidance that basically says if more than 50% of the loan repayment comes from the sale or rental of a property, that's commercial real estate. You'll also hear this called investor-owned real estate. And as we get started, we have our second poll. So Anne, if you could launch that. Okay, so here's, again, this is related to CRE. So the problems with office properties are well known. All you have to do is pick up any banking journal or Wall Street Journal or anything, and you hear about offices. So the question is, do you foresee issues with any other property types? And I've only listed 4 here. I left residential out. So the other 4 are multifamily, industrial, which would include warehouses, healthcare, which could be medical office buildings, hospitals, doctor's office, and then retail. So if you would select one or all of these, whichever you think, we're curious as to what you think. Okay. So 40% multifamily, 34 for industrial, 26 around 79 retail. Okay. So this will be interesting. You're going to see what's actually happening in just a few seconds. So let me move on. So here's the CRE performance trend, both non-performing in the dark blue, and then the past dues in the gold and green. And we're going to focus on non-performing as the delinquencies are basically minimal. And for the past year, the percent non-performing had stabilized pretty much in the 1% range. But with December, we saw a really big jump, a significant jump up to 1.16%, mirroring the jump we saw for C&I. And similar again to C&I, we haven't been this high in a while, and really haven't been this high since, for CRE, pardon me, since late 2021. Sorry, losing my voice. So let's take a look at what's happening. So you remember your answers to the poll questions, where I think most people, if I wrote down correctly, said retail was where they're expecting problems. I would suggest you take this and match it up with your answers. There's a little movement for 4 of the property types, but there's some big swings for 3 of them. On the positive side, lodging continues to improve. It's now below 3%, and it is no longer the worst performing type. It's been the worst performing type, I think, since September of 2020, if I remember correctly. Unfortunately, the improvement for lodging is being offset by increases with office, which has more than tripled, and then also increases for healthcare, which is above 3%, actually the same as offices. So we have some good news and then some bad news. And let's take some further looks at what's happening. Here we have the change in non-accruals by region. And just a reminder, in CRE, geography is the location of the project or the building, not the address of the owner. So if a builder lives in New York City, but they're building something in Memphis, Tennessee, we'll use that as an example, this comes up as being in Tennessee. And we have big changes for the South and the Southwest. In the South, the problems are primarily with offices, with a little bit of health and retail issues, not as much as offices. Offices definitely driving it there. In the Southwest, again, there's problems with offices, but also with multifamily properties and healthcare. And as I mentioned, the improvement in the Northeast is primarily due to improvement in lodging, but we're also seeing problems with offices in the Northeast. But the improvement in lodging is offsetting that. So let's move on to the credit quality for CRE loans. And when we first split CRE into a separate database in 2010, you can see the poor credit quality there on the left side. But as the recession ended, CRE improved dramatically. And at one point, the weighted average risk rating for CRE had dropped to 4.7%. You can see the bottom there right in the middle of the chart at almost at 2020. But since 2020, CRE quality slipped, then recovered somewhat, and is slipping once again. We're going to examine why the quality is deteriorating on the next couple of slides, but you can see we're back to levels that we had as COVID hit, but levels we really haven't seen since we were coming out of the recession. So here's the risk rating composition chart. High pass, moderate, low, and criticized for CRE. Again, December in the blue and September in the gold. And once again, similar to what we saw with CNI, you're seeing the shift from left to right to the higher ratings. And it's even a little more pronounced here, particularly with the low pass loans. The high pass loans in CRE were few to begin with, and usually aren't many to begin with. They're almost non-existent now. But the low pass and criticized represent a third of all CRE loans. And on future webcasts, we'll be updating this chart to see if the trend reverses. But right now, I don't see a lot of cause for optimism to think that this low pass number and criticized numbers are going to drop very much. So this chart gives you a little more detail on the distressed mix. You see the spike in the sixes, but what concerns me almost as much as the jump in the eights. We frequently see bumps in sevens that return to pass, but now you're seeing a significant amount of sevens going to eights, meaning that these properties are not recovering, they're getting worse. And I saw just this morning, there was a hotel in the Philadelphia area, I think the name is Club Quarters, where the owner is given up as returning the keys to the lender. So you're starting to see a lot of that. I know also, I guess Blackstone has been turning in some properties. So, banks seem to be holding on, lenders and borrowers have been holding on for a while. But now people are just saying, I can't do it anymore. And we're starting to see some of this crack. So here's distressed by property type. And if you compare this with the performance by property type chart, where we had jumps for office and healthcare, the change in credit quality is unfavorable for everything except lodging and residential. If you think of risk ratings as being, projecting what's going to happen, the outlook for every property type except lodging and residential is unfavorable. And we saw just in this past 9 months, big changes for office, multifamily, and industrial. We're going to get to office in a second, but the multifamily and industrial declines are basically new. And what we're hearing is that there's for multifamily, a large number of units are coming online. And the rents for those, people think those are going to be rented out. But what's going to happen is that's putting pressure on the Class B properties. As these new units come with a lot of accessories and extras, the Class B properties become less and less attractive. For industrial, what we're hearing from our customers is that a lot of spec warehouses that were built as specs are vacant, as the increase in e-commerce that we saw initially with the onset of COVID has stalled. And I pulled some numbers from the Census Bureau this morning. And in the second quarter of 2020, e-commerce sales represented 16.5% of all retail sales. That's down now here in the second quarter of 2023 to just 15.4%. So when everybody was buying through Amazon and everything else, that's sort of stopped, as now people have wanted to get out and just have stopped buying. And then also, which is not shown here, but for all of this, a large portion of the CRE loans, about 40%, are maturing within the next 2 years, and they will need to be financed at the much higher rates. And as a senior lender recently told me, what cash flowed at 4% just doesn't work at 8 or 9%. So it's going to be a challenge to get all of these loans refinanced. So a quick note about offices. I haven't spent much time talking about the problems with office because I assume if you're interested enough to be on this webcast, you have a general knowledge of what's happening in the banking market with office lending. But here on the left side, you see that just about 50% of office loans are maturing within the next 2 years. And most of these loans were made 5 years ago when rates were in the threes, the fours. And if you remember the chart I started with, you'll now have, for example, $10 million loans being renewed in the 8 to 9% range. And if you think of the cash flow impact on a building that has reduced occupancy, which is what we're showing on the right-hand side, the ability to service this debt is going to be questionable, as a lot of these vacancies are just shy of 20%. And one more comment about the 49.7%. Over half of those are risk rated 6 or higher, so low pass or worse. So if you're expecting a life co or an equity fund to take you out of some of these loans, I suspect that might not happen as quickly as you'd expect. I don't see a rush to refi these credits. So here's distress by geography. And we saw the same thing with the C&I portfolio. Distress levels have increased throughout the country, Western Midwest being the one exception. And if you look at the Middle Atlantic, almost 1/2 of the Middle Atlantic portfolio is distressed. And again, if you think about that, that means almost half of my loans are low pass or worse. That would not, I'd have a hard time sleeping at night if I knew that. Within the Middle Atlantic, we're seeing distressed properties, for instance, office at 58%, industrial and multifamily is at 50%, right at 50, and retail is at 46. So not a pretty picture for the Mid-Atlantic area. All right, so we're almost done. This is our last chart, but we do have a poll question after this, so stay with us for that. I'm really curious to see the answers here. So we have, again, the property types on the left. This is their chart that takes the performance and the credit quality and puts them together. Property types on the left, non-performing in the middle or red, and credit quality in gold on the right. And this doesn't match up at the extremes as well as what we saw for C&I, but the 3 highest non-performers are also have the 3 highest weighted average risk ratings. So worst performers have worse credit quality. And those 3 worst are office, lodging, and healthcare. Okay. All right. So we'd like to finish with another poll question that's kind of a forecast question, if you would. So Anne, if you could launch that, we'll do the poll and then we'll open it for questions. So in American Banker, I think it was, the management of a major Midwestern regional bank recently indicated that a large charge-off was idiosyncratic. So do you believe recent borrower failures, and I'll list a couple here, Rite Aid, Yellow, the trucking company, Bed Bath and Beyond, etc., are one-offs or are indicators of an economic softening? And so you get one choice here. The first is you agree with the Midwestern Regional Bank exec that these are one-time events, nothing to be concerned about. The second is kind of a, you're not quite sure, so it's the start of at least a slight economic downturn. And then the last is you're very pessimistic and you view this as the beginning of a true recession. And so we'll wait a second and see what everybody thinks.
We still have a few answers coming in, so I'll give it a few more seconds. I feel like it's like watching popcorn in the microwave.
Pardon me.
All right, I'll end the poll.
Oh, 11, 61, and 27. All right. I was thinking this is probably where people would come out. There's a one-time event. I go back, and again, I'm not trying to be preachy. I apologize if it comes out like that. I go back to when things started going bad, 08, 09, and you started seeing the little one-offs here and there, and people were saying, one-time event, no big deal, don't be worried. And then all of a sudden things were bad. So, all right. So let me close everything, and Anne, I'll turn it back over to you to see if there's any questions.
Yes, thank you. So if you have any questions, if you just want to pop them into the Q&A, we can answer those. I'm not seeing anything come through in the chat box or the Q&A box. Oh, hold on, we do. The first question is, what is your answer to the last quiz? Or what do you think?
I knew somebody would ask. Uh, I, I, I'm in the middle with everybody else. I just can't. The economy has been extremely resilient. I recognize that, but I just can't see how the increased rates and the high inflation don't take their toll. And the other things that concern me are what's happening in Israel. The instability there is all, that's one of the things we saw when the Ukraine problems hit. That's always an unknown factor. So I think at minimum, we're going to see a slight downturn. And I think earnings came out today, and if I remember correctly, well over half the banks have increased their reserves. So I think that's kind of what everybody's thinking, that it's going to be, something's going to happen. And I guess the other thing that happened today, I guess the GDP was way up, which leads me to believe rates are going to go up. So the higher for longer is going to be here. And it's only a matter of time before, again, the example with the housing, people stop buying houses, they stop buying refrigerators for their new houses. It's just a snowball effect. I'm hoping it'll be slight, but I think we're going to see something, and we're seeing it already with the data. So sorry. All right.
Thank you. Other question is a copy of the presentation. We'll send that out to the attendees after we conclude. Another question is, does slide 10, the war trend, include 8 and 10? And what does it look like if you only include 1 to 6?
So slide 10, this one, I think. So it does include everything. And so the question is, what was that question again, Anne?
And what does it look like if you only include 1 through 6?
Okay, that's something I'll take away as a to-do for next month.
Okay, the next question, for the West Cree, do you have a more detailed breakout between the states composed here?
We do. We have the ability to go down to the state level. So if whoever's asking this question, if you would send me an email, I can get those statistics for you and send that to you.
Sure, and I could clarify that too. It's but also we can follow up with Joseph as well, but it's specifically looking for Oregon, Washington, and California markets.
All right, sorry about that.
Nope. And then also related into this is the data set underrepresented to the West, because the attendee is seeing elevated stress in Western markets more than perhaps indicated in the Cree charts.
No, I would say that the data is relatively equal in everything except the Western Midwest, which is, Montana, Wyoming, places like that. That is compared to the others, that's one of the lowest regions, but the other 6 regions are just about equal.
All right. And that is actually, right now, that's all the questions that we have, but we will give it a couple more minutes to see if there's any additional questions coming in. All right, I think that looks to be it, but feel free to email us afterwards if anything else comes up. And thank you, Tom. Thank you, everyone, for attending, and that would then conclude our webinar.
Thank you.